Meet Harry Nicholls.
So we started primarily as the conduit between e-commerce founders and private equity firms.
He's the co-founder of eVenturing, a firm that helps Amazon brands scale, grow, and exit profitably.
There's a profit and there's a multiplier that gets attributed to your profit within the business. We're not looking at any complicated tech valuations.
From helping with the international expansion of over 50 US brands,
The US international expansion offering, which has kind of been born, particularly more recently accelerated,
to managing multiple 8-figure exits, and even showing major players how to unlock Amazon as a serious growth channel. These guys know how to amplify growth.
There is virtually unlimited growth for an Amazon business available.
Join us in today's podcast as Harry breaks down what separates brands that scale from those that stagnate on Amazon.
The product side to kind of dig into that a little bit, have something that the rest of the market doesn't have.
Why the UK and EU are low-hanging fruit for US brands, and how they can avoid the landmines.
Going global, but particularly US to UK and EU, is so much easier.
Plus the exact roadmap to 7 or 8-figure exit, including how buyers think, what multiples look like, and what actually kills deals.
And on day one, reverse engineering that roadmap to the point of exit that hits on those motivations.
Hey guys, if you're enjoying the videos, why not consider subscribing? We drop bi-weekly content that will help you improve your business right here on the channel. Harry, thank you so much for joining me on the podcast. It's great to have you on.
Thanks for having me.
I want to get straight into it. So you guys at eVenturing have kind of 3 services behind what you do. So there's the kind of growth offering, international expansion, and the exit. Can you just talk to the story behind how that came about as a service offering?
Yeah, 100%. So we started primarily as the conduit between sort of e-commerce founders and private equity firms that are looking to acquire businesses primarily within the Amazon white labeled space. And this is going back 2020, 2021, when there was about $16 billion of liquid capital raised by about 100 different players virtually overnight in the world of free capital and LOIs being handed out like they were confetti. There was on one side these super impressive C-suites coming into the e-commerce space, ex-Wall Street, ex-Goldman, ex-JP coming in, but didn't perhaps have experience, knowledge in depth within the e-commerce space. And likewise, there's e-commerce founders that built fantastic brand products, but might not have been through an exit of their company before, and they may not have ever been represented either on the buy or sell side of any kind of M&A transaction. So amidst this, there's $16 billion of capital that's been raised. It's lockdown at the time, which only emphasized kind of the FMCG PE space. Is impetus to go and buy up online e-commerce businesses because the rest of the world had just been shut down. So eVenturing was really born into sitting in between that deal flow, representing the sell side, the founders, and partnering with them sort of anywhere between 6 and sort of 36 months, I suppose, prior to their kind of desired exit point. We would work with them, throw in a operational management team and reverse engineer the optimal exit on their behalf and then broker that in-house. So we went around in sort of 2020, 2021, 22, drawing up a load of these deals where we would get usually minority stakes, equity positions within these Amazon businesses, partner with them, insert our management team into their operations, and drive that equity value for a period of time before brokering the deal in-house. And that was brilliant. We built a really effective balance sheet, built a really nice balance sheet of lots of different equity positions in a host of 30 to 50 businesses at the time. But trying to extract money out of a growing business is never an easy thing to do. And obviously we had to keep the lights on. So we didn't ever want to have a conflict of interest in which we were rushing exits on behalf of our partners to keep our lights on. So partly because of that dynamic internally, but also partly because we would negate a lot of the market on the e-commerce side if we only offered these sweat equity positions. We chose to broaden it out to offering purely consulting kind of incubation services across the Amazon space as well. So we now work with quite a lot of household names. So take Charles Tyrwhitt, for example. The sweat equity pitch doesn't quite land as well to take 10% of Charles Tyrwhitt, a $500 million brand, for return running their Amazon services. So partly didn't want to negate a large part of the market, and I think commensurate to some of the bigger trends that we're seeing in the wider space of these bigger names getting more involved into the e-commerce Amazon space. We wanted to open the doors to them. Also partly because internally we wanted a kind of consultancy model that almost paid for the cash flow of our equity piece and allowed us to kind of continue operating on that side without a conflict of interest. And what you're left with is three models, I suppose. Number one, on this road to exit, which still remains the bulk of our book. Number two, a consulting piece in which we are incubating larger companies, usually their Amazon, which is a meaningful portion of their businesses, even for these household names. And then that third piece is the US international expansion offering, which has kind of been born, particularly more recently accelerated in its Trump tariffs, but I understand we'll get onto that conversation a little bit later, is you've got American businesses that, in effect, are 7-8 figures by default. If you're a successful business selling on Amazon in America, you're at a decent size. And with that, you've probably got an incumbent setup, whether that's an agency, in-house, whatever. You've got something good going to have scaled successfully in America. Now, what happens is they tend to turn a little bit of a blind eye to the UK and European opportunity on the grounds that it's an extra 5 to 8 marketplaces to manage, language nuances, regulations a lot more strict. And at best, those marketplaces combined are going to be equal to that of America. So we think if you can compete in America with all of the harsh competition that's out there, you can definitely compete individually in the UK, Germany, France, Italy, Spain, etc., etc., etc. And it's almost low-hanging fruit to come and sweep up that market share once you are that established big US brand. But that's not to get away from the fact that there is a good 3 months of bureaucracy and admin ahead of that time period. So kind of opening the doors to those clients as well, not needing to come in and replace their internal outfits that are already working well, but still being able to offer a solution to American businesses looking to kind of dip their toe on our side of the pond.
Okay, and just kind of double tapping on that then. So geographically, are you exclusively UK, or do you also cover the kind of European region?
So we've got management capabilities to manage in UK, US, Canada, continental Europe, basically anything in the European Union, Australia, and Japan. So it's global in that regard. I think the e-commerce playbook remains in place by and large, irrespective of the marketplace. There are obviously nuances, both culturally and more e-com centric nuances, and kind of respecting different market sizes and the market dynamics that come with that on both the sell and buy side. Regulations obviously a big one as well, but we've got bases covered. So we're global in that regard. I'd say our clientele remains probably about 50% UK, but the goal will always be to take any brands we work with global, and probably about 30% American and 20% elsewhere.
Okay, and then in terms of that kind of period leading up to 2020 and getting started beyond that, I know you guys, you and Sam worked in kind of finance beforehand in London. How did that kind of set you up for what you do today?
Yeah, well, I think it was the catalyst for the original business model at eVenturing, which was that roadmap to exit. It was Sam's older brother that had a Amazon business, and Sam was sort of a graduate trader over at Barclays and Deutsche, and working 16-hour days. Really getting rinsed and ruined by London's wonderful finance grad schemes. And earning decent money, but a grad and very much small fish in a large pond, and had probably 10 of those years ahead of us. So I was in a similar position a few years later. And his older brother had started a business online, selling supplements, doing well into the 7 figures, really healthy net margin. And at the time, going back to 2018 days, probably working half an hour to an hour a day on his Amazon business. This was back in the day when competition was super low and he was early to the game. So Sam got to a point in which he said, Joe, tell me what you know. I could probably do without the 16-hour days and intense work-life balance. There's obviously money in this space. And then following that introduction into e-commerce, we're able to kind of get a very good finger on the pulse on how the e-commerce and Amazon world was developing, but also obviously had that financial background. So when that private equity money then came into the space in the abundance in which it did, we were quite uniquely placed to be able to represent both sides, at least in kind of being that conduit in those transactions. And there wasn't really anyone at the time that kind of understood the nuances and the ins and outs of both sides of that deal flow. So it was a good place to sit at the time. And as I said at the start, kind of branched out since to cover all bases across the Amazon side of the business at least. But yeah.
Okay. So for sure, you guys had that kind of experience, helping businesses on that road to exit. How did you pick up the kind of Amazon skill set and the kind of, growth and consulting piece of the puzzle?
Yeah, so by the time I joined the company, which was back in 2021, so about 4 years ago, the blueprint was largely there and in place. And I think that was probably 2 or 3 years in the making before I joined eVenturing. But ever since, it's been a consistent kind of trial and error, but a refinement of that blueprint. It's a very fast moving, dynamic space, and nothing stays the same for more than 2 minutes, both on the Amazon world, but also geopolitically at the moment is quite topical. So being able to, work with the evolving space is super important. I think that comes down to having a very well qualified team initially in that management and kind of that core unit back in 21 when I first joined, but then also then how we've sculpted that underneath since in making sure that we're hiring from the right backgrounds. And it's either on our side hiring from e-commerce backgrounds and teaching people the financial elements to the job and actually how to run a business as well as how to run a strong Amazon display page. And then the converse thing is to hire from finance backgrounds and teach the e-commerce playbook, which in all honesty is a lot easier to do. There's a playbook, it works, and it's a 3-month very intensive training program to kind of get people up to speed on that e-commerce industry, and it's very similar principles that they will have learned from the consulting, IB, or accounting backgrounds that we tend to hire from.
Okay. And just diving in now to the growth piece of the business, in your experience, what separates a brand that maybe kind of hits 6 figures and stagnates versus those that go on to push past kind of 7 and 8 figures on Amazon?
Yeah, so I think you need to have you need to be unique in one of three things, and that's either product, brand, or legacy on the Amazon platform specifically. Um, and largely speaking, product turns to brand, brand turns to legacy over a period of time. But in an ideal world, you have all three, but you need to have at least one of three. I think it's the biggest critiques of the Amazon marketplace is that from a sale perspective, it's perfectly competitive at times, and it's the job of a seller to kind of differentiate themselves from being perfectly competitive. So where can you not be homogenous with everyone else on the platform? And that really, when you whittle it down, is one of those three things. So what I mean by that on the product side, to kind of dig into that a little bit, it's have something that the rest of the market doesn't have. Now, again, going back 7-8 years ago, that was pretty simple. There weren't. It was an up and coming industry, and therefore, if you had a resistance band and a good supply chain, you could launch a resistance band, and with some half decent branding, you would rank well and you would sell well, and you'd have a really strong business selling resistance bands. I think if you tried to launch a resistance band company on Amazon today, you'd really struggle. The time was to do that 10 years ago. So I think you've got to have something unique. Now, that's not to say that you couldn't launch a resistance band full stop, but I think you'd have to run search volume analysis, dig into a niche within the niche in this day and age. It's either an emerging trending product that didn't exist, this time last year. So yeah, you've really got to kind of find that niche within the niche. So whilst I wouldn't ever try and rank for the keyword resistance band, which will have hundreds of thousands of searches a month over in the US, simply too competitive. You'd have to go into the red 5 years running on ad spend until you start organically ranking there. You have to have very deep pockets to make that worthwhile. Where there could still be a place for you is within, say, Pilates pink resistance bands, and you've got a really concerted demographic and kind of customer that you're going after, and you can own that space. And there might be 30 keywords that represent that space, all with anywhere between 1,000 and 2,000 search volume. And as long as the goal isn't to come in and be ranked number one for resistance bands on the Amazon platform, that's fine. It all depends on how much search volume is going through that Amazon keyword, which is effectively the demand in the market, against how many suppliers are trying to play the game and rank for that keyword. And then are those suppliers there kitted out with a product that fits that search demand perfectly? And if not, there's probably a gap in the market to go and exploit. So you've got to find those niches and gaps, and that's either niching down from a niche, or it's a case of finding something new that didn't exist this time last year. And you see a lot of the time. I'll give you an example of last year, lion's mane. No one knew what lion's mane was as a supplement until it started going viral and doing the rounds on social media. The time was 18 months ago to go and launch lion's mane. And you look at some of the successful brands that have come out. That Space Goods has been a huge case study that did really well to capture that wave of traffic. The example of 2023 was ice baths. Again, getting into that early would have been huge, but if you go too late, you've missed the boat, because then you don't own that brand or legacy, so you're not the first there. Everyone's gone ahead of you. They've already built that review base, and then it becomes really difficult when those suppliers do start entering the market en masse. How do you then stand out on the platform, particularly once they've already got economies of scale, proof of concept achieved, and they can outcompete you on supply chain and therefore price at the end consumer? So that's product. Brand, I think, is a very different story. And I think that is number one. It's an absolute must have to have a very best in class Amazon listing and offering. And I'm constantly surprised at the amount of big brands that still don't have that. And that's a hole we're trying to plug as we speak. They allow their third-party distributors to compete over a buy box en masse. There's a huge free rider problem, and no one's got the authority to make the necessary changes to the listing, so they don't convert well. But they still do a very good job through a real intensity on brand equity away from the platform. And you're constantly seeing this dynamic on Amazon with challenger brands that play the Amazon branding game incredibly. Images are perfect, clearly A/B tested for click-through conversion, A+ brand story, all premium and spot on, but lacking the brand equity away from the platform. And you've also got these higher end brands, which their brand equity carries them through on the platform. And what I'm seeing a lot more of at the moment, and where we're doing a lot more business, is with those more household names, the bigger brands that do have the brand equity. We can come in and be their operational unit and arm to make sure that they're ticking the Amazon box as well. And then once you've got both, it's a real recipe for success on the platform. Gone off on a slight tangent there, but effectively, brand, product, or legacy has to be unique in one way, shape, or form. Otherwise, you're in a perfectly competitive market and it's impossible to make any real margin.
Two questions on that. One is so when you have that uniqueness and you've got that kind of gap, does that mean you can set price essentially, and that's where the profit is made? Otherwise, you're kind of in a race to the bottom.
The answer is probably not. If we're talking about launching batteries on Amazon in this day and age, or phone cases, or sellotape, or these things have been done, you are not going to be able to enter the market and outcompete those that are already there, because the real estate of that number one rank is just too valuable for those incumbent players to be willing to not do it properly. So as long as you've got legacy, by all means, you can come into those marketplaces and make real margin, because I think the quantity of reviews as well as the quality, but the quantity of reviews that you have on Amazon is a huge determinant in their ranking algorithm. And when you strip the game back, there's three things that matter. It's how many eyeballs are you getting to your product? Once they're on your product, how many of them click on your product? Once they've clicked on your product, how many convert on your product and actually buy the product? It's impressions, click-through rate, conversion rate, only three metrics that matter. And with that, those first impressions that you're getting organically from that rank number one position is what is the make or break of success. And if you're launching something without an incumbent review base and therefore that legacy, and nothing different that the incumbent players aren't doing, you're not going to play the Amazon algorithm and beat the incumbent players. So in that instance, you have to overspend on advertising to try and catch up and win the sponsored slots rather than those organic slots. And with too much of your revenue coming from those sponsored positions, without that organic position coming up the rankings, which it won't if you don't have anything different, it's very difficult to compete. So that's where it's niche within a niche. Know your customer, brand accordingly, and if you can win on brand, you're perfectly fine. If you can win on legacy, you're perfectly fine. If your product's different or unique in some way, shape, or form, again, perfectly fine. And there's profit and healthy margins to be made on the platform, but it's got to be one of the three.
Oh, good. Okay, so for a business that's maybe native to Shopify or let's say TikTok, at what point should they start to look at kind of Amazon and adding that as a channel?
Yeah, absolutely. So this is where I'd refer back to product legacy that won't exist. That's product or brand. So if you've got a unique product that no one else is selling well, and there's search volume for it on the Amazon platform, it's a recipe for success. Now, you've got to, the reality is, if you launched a fully functioning time machine and tried to list it on Amazon, I don't think you'd make a sale. The reality is, Amazon is a search, find, buy platform. You can't create the search volume on Amazon. So you're confined to the search volume that already exists. The Amazon game is a case of reverse engineering the search volume that represents demand for your product and making sure you're visible for that search volume that already exists. So that's where I'd say it's really dissimilar from Shopify and TikTok. The sales funnel is one step smaller. On Amazon, there's impressions. Well, there's already the searches, there's already the demand. You've got to be visible and you've got to rank organically well. Then you've got to make sure people click on you once you are seen, and then you've got to convert. But you're converting traffic that already holds that demand for your product, and therefore it's one step sooner. On social media and TikTok, you're often putting the demand intent in people's heads that they didn't know that they had. So you don't have that confine of search volume as a limited glass ceiling, I suppose. So this is where on Shopify, which is usually powered by social media ads, Google ads, etc., email marketing as well. Can't forget that. And then TikTok as well is obviously the social media side. You are creating that demand through influencer traffic, through paid ads, etc., etc. You are creating that demand. Then you've got to convert it and then, or get people to click on you and then convert it. So once people are putting sufficient budget behind influence campaigns, paid ads, whether they want to or not, whether it's well intentioned or not, they will create search volume for that product and for their brand on the Amazon platform. And we see it time and time again where you've got these D2C brands through their own website creating huge amounts of traffic on the Amazon platform for their own brand name, and they will have 3,000, 4,000, 5,000 searches a month for their own brand, and then not on the Amazon platform to service it themselves. And that's because they would rather point the traffic to their website. You don't have to pay Amazon's kind of platform fees, and it's more economical from a margin perspective. But whether people like it or not, that traffic finds itself on Amazon because often the consumer's more loyal to Amazon than it is to a brand that they've seen for the first time on social media. They already pay their $8.99 a month for Prime. They already pay, they like the security of card checkout, and they like next day delivery, and they've got very well used to that. So the customer often comes onto the platform, and either they're looking for the brand and it's not there, and maybe half of them will then go and find the brand on their own website, but I'd hazard that a lot don't, and a lot go to the next best thing on Amazon. So a lot of the conversations we have is with brands that are doing hugely well on TikTok, on Shopify, and saying, look, the genie's out the bottle. You've got search volume on Amazon. You can then hoover that search volume up, and we can reverse engineer that search volume that's already going through your brand to make sure that we're capturing the wider demand for that product across the Amazon platform. So again, just to give an example, going back to Charles Tyrwhitt as an example, Charles Tyrwhitt have 3,000 to 5,000 searches a month going through Amazon in the UK for Charles Tyrwhitt. They've got another 2,000 for Charles Tyrwhitt dress shirts, etc., etc. There's a load of different permutations. We launched them onto the platform, but for the last 10 years, they've not been there to scoop that up. So that then goes to the next best thing, and it will go to their competitors. a lot of these guys will find their way onto Charles Tyrwhitt's website, but a lot would probably stick on Amazon and convert on the website. So it's then positioning them, hoovering up the branded search volume that already exists, and that's really low hanging fruit. But it's then positioning the brand accordingly to take that brand equity and then make sure that we're ranking well for men's dress shirts, which has 25,000 searches a month on Amazon, and not just hoovering up the branded search, which, as I say, should be very, very easy to do, but also making sure that we're then ranking well for that wider search intent across the platform, which is, as you can see, 10 times more valuable from an Amazon perspective.
Okay, so on the flip side, then, is there kind of any Shopify or D2C brand that you'll look at and be like, oh, this won't work on Amazon, or any red flags that you look out for?
Yeah, so I'd say the only thing that's a real red flag on Amazon is really low RRP products. So the way Amazon's pricing works, obviously everyone knows Amazon's with Prime, you get your free delivery. That's because the seller effectively pays the free delivery. So if you're paying for your what's called a FBA fee, you're paying a minimum of really £2.50 in the UK, $3.30 in the US. To be able to pick, pack, and post next day through Amazon's fulfillment network. So if you're selling toothpicks or a pack of chewing gum, it's not going to work from a unit economics perspective. Where you can get around that is multi-packs, and that's why if you're ever looking to buy a bottle of shampoo on Amazon, you can't. You have to buy 12, and that's purely because you've got to make it significant enough for that kind of delivery fee to be netted out. If you look at that from a Shopify perspective, you would charge your $1.99 and mark up your cost of goods at 50p accordingly. But you would then put a £3, £4, £5 delivery fee on top of that, and then it's the consumer's discretion as to how many they want to order to kind of blend that fee out. On Amazon, it's the seller that pays, so therefore the minimum really that's viable from a economics perspective is an RRP above £5 in the UK is just about doable. Ideally above 10, to be honest, to really have margin going through it, particularly when accounting for ad spends that will be required. In the US, that's higher, just because to pick, pack, and post from Texas to New York is a lot further than London to Coventry. So.
Okay. I want to talk now about some growth levers. So you mentioned this before with kind of Charles Tyrwhitt and how you initially go after kind of branded terms and then you'd go after the kind of wider demand. When you first take on a brand, what kind of quick wins do you look for? And then, are there kind of more longer term plays that you'd also look at trying to
Yeah,
roll out?
no, 100%. So I'd always break that down into what I would refer to as operational and kind of structural things. And the operational pieces is everything on the Amazon platform. So all of the more digital marketing principles. And then structural is everything kind of running the business as a whole. And I would say operational wins are the quickest. If I would spend a day working in a PPC console, I would notice the difference in performance tomorrow. Not necessarily me, but anyone doing that. Likewise, if you were to move a price point on a listing on Amazon, you would notice the difference in your sales and margin the next day. Likewise, if you were to change a header image, you'd notice a difference if it was significant enough. If you were to change the copy in a title or bullet point, something of that ilk. These things are really immediate and it's live publishing, and therefore if you change something today and you're being put in front of a million eyeballs on a daily basis as a leading product, these 0.5% deltas in performance on any click-through rate, conversion rate, impressions make a huge difference. The average click-through rate across our portfolio is about 1 to 1.5%. If you just move that by half a percentage point, an extra one person in 200 clicks on this listing that looks at it, you increase your sales by 50 to 33%. So all else being equal in the rest of the funnel. So those operational wins are imperative for quick, low-hanging fruit. And running any kind of operational analysis, the first thing I'd look at is those three metrics I spoke about earlier. So the number of impressions that the listing's getting relative to the competitors in the market, the click-through rate relative to Amazon averages, but also making some accommodation for the category that we sit in. And then same again for the conversion rate. If you're selling sellotape on Amazon, your conversion rate's going to be a lot higher because it's quite commoditized. People know what they're looking at and they're not going to change their minds once they've clicked on it. If it's sellotape and it looks like sellotape and it is sellotape, they'll probably buy it. If you're selling sunglasses, people might do a lot more window shopping. So there's a natural accommodation for lower conversion rates. But pretty much for every product that a brand is selling, we're going to need to benchmark what are the impressions that it's getting, where's the click-through rate for each, where's the conversion rate for each. If you've got a really strong conversion rate across a listing, then you can really scale that through the advertising console. You can't scale a bad converting listing. Reason being is that Amazon's fully operating around a pay-per-click sponsored model. So you're paying every time someone clicks on your listing. Therefore, the less times you have to pay for that click per conversion, the higher margin you're going to be and the less you have to spend on advertising. If you've got a product that's converting at 5% and the amount that you spend for every click on your listing is £1, you have to spend £20 per sale on the sponsored side. If your conversion rate's 25%, which is very doable, then you pay £4 per sale. So first and foremost, before going spending money and scaling, you've got to make sure you've got a listing that converts well. That's done across branding refreshes, that's done across the way that the listing speaks to the consumer, as well as the kind of SEO that's kind of backed up within that and communicating with Amazon's algorithm. How's your price point relative to kind of the value that you're offering through that product? All of these things, the fulfillment method, you've got to make sure you're on Prime if you're selling on Amazon, really, if you want to convert well. People expect their next day delivery and they expect it to be free. So ticking all of those boxes and making sure we've got conversion rate that scales well. Then once you've done that across the board, you can really hit the scale button by going wider on the advertising. And again, to break that down into a little bit more detail, you can go wider by targeting more keywords, more products and competitors, or likewise more audiences. And also you can afford to spend more per click if you've got a higher conversion rate, rather than scrimping and saving on the amount that you're spending per click with a lower conversion rate. So again, you'd split that catalog out. How do we marry up? If we've got strong converting products, can we go further and wider with advertising? If we've got a poorly converting product, okay, how do we convert that better before we spend any money? Is kind of the bread and butter. They're your quick wins. That you can figure out in a day, put together a plan for, and execute within the first kind of 1 to 3 months. There's a lot of trial and error, basically a series of A/B testing across those planes until you move those metrics to where you want them to be. And then there's diminishing returns across, how much you can really level up the same listings conversion rates. From the first 3 months of A/B testing, you might get it from 10 to 20%. From the next 3 months, you'll do well to get it from 20 to 25, and so on and so forth. So once you've then got your listings hitting the impressions and kind of representing the demands that exists, again, you can't really move the demand, but you want to be ranking well for all the keywords that represent demand for your product, and you've got strong click-through and conversion rates thereafter. The name of the game is to turn to the structural pieces, and that is either launch new products or launch new marketplaces. So we often inherit Amazon businesses, UK only. Brilliant. First step is to go and do all of that across the operational piece. And that in itself can be anywhere from a 3-month job to a 12-month job. Depends on the size of the catalog, but ultimately a series of A/B testing to get that right. Then once we're kind of hitting that apex of the diminishing marginal returns curve, what we really need to do is start thinking about what's the next thing that's going to push this brand forward. That could be an European expansion, that could be a US expansion, that could be launching a new product altogether. If you're a supplements brand and you're selling vitamin C and vitamin D, go and launch vitamin B, hypothetically. But also, if you're a supplements brand that sells vitamin C, create variations within your products, and that is twofold in doing the next thing, but it's also a surefire way to boost that conversion rate. A lot of the time people click on your listing is because they think it's going to be marketed towards what they're looking for. When they get to the landing page, it's not actually the products that they want. They might click on it and it's vitamin C 60 capsules, or really they're looking for 120 capsules, or it's vitamin C for ages 65 plus, and it should be in their 40s. It's vitamin C for men, they're all blah 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 blah. If you've got a listing and a product, and underneath that you've got 60 capsules, 120 capsules, 240 capsules, some for men, some for women, you cover all bases in that regard. You get 2 variation types per listing, so play within those confines. But it's also a way to increase margin, but B, a way to increase your sorry, A, a way to increase conversion rate, but B, a way to increase margin, just on the grounds that if you are selling 60 capsules, it goes back to what we were talking about, that low RRP piece. Whereas if you're selling 240 capsules, you will be able to price higher, you'll be able to blend out those advertising fees and blend out that fulfillment fee to a better extent, produce a more compelling offer to the consumer from a price per capsule perspective, but also be able to make a lot higher margin as well, even after the fact.
I want to talk now about the international expansion piece of growth. Is the majority of what you guys do there is kind of take US businesses and get them into the UK and Europe, or is it kind of the other way around as well?
It's both. One's a lot easier than the other, to be honest. So the US is 65 to 70% of all Amazon globally.
Well,
And with that, there's a lot more demand, as I say, 65 to 70% globally. But there's also, therefore, it attracts a lot more supply. With that, if you can compete well in the US, you can definitely compete well in the UK and EU. Reason being, you accumulate so much more volume. So A, you can win on economies of scale across the supply chain, probably benefit from cheaper cost of goods relative to your UK EU counterparts because you'll be buying in higher volumes. But B, you will have accumulated more reviews on the Amazon platform by virtue of the fact that you've done more sales on the Amazon platform. The reviews is such a needle mover in the way that you rank organically on Amazon. And therefore, if you take again, let's take the resistance band market. If you type resistance bands into the US, the top 4 players will have 50,000 reviews plus, and maybe the odd exception. But that is the bar. That's the barrier to entry almost. In the UK, the top 5 resistance bands might have an average of 5 to 10,000 reviews, maybe 10 to 20,000 these days. But point being, it's chalk and cheese. If you take that US brand, launch it in the UK brand, it quickly propels to number 1 just because of the way Amazon's ranking algorithm works. And that's a fundamentally easier thing to do than taking your 5 to 10,000 UK listing and trying to launch it in America. Not least because of the fact that also because of those supply demand dynamics, the cost per click is remarkably higher in the US. So you do well to get a cost per click under $1.50 in the US. In the UK, that probably averages at 70p, 60p maybe. In France, you're probably looking at 30 cents, 40 cents. That might be being slightly hyperbolic in France, but that's certainly true for, say, Spain. Anyway, point being, it's so much cheaper to advertise in the UK and EU versus America, and you're coming in with a huge review base advantage. Once you've been through that administrative, slightly bureaucratic first 3 months of getting everything set up from product compliance, regulatory, and kind of VAT perspective, you've got a very nice playing field to operate within.
okay, so would you say that the US market, for the same product between the UK and the US market can take and support a much higher price point?
Yeah, I think fundamentally price points are slightly higher in the US. It's product dependent, but consumers are willing to pay a little bit more in America. What we also find is, going back to that point on variations, is Americans love a bundle relative to Europeans. So whereas a 2-pack of anything might be a bestseller in the UK and EU, in America it quite justifiably might be an 8-pack, and it's of 8-packs that you wouldn't ever think you need 8 of something, but it seems to catch the American gaze. So I think they're definitely higher spenders. There's definitely evidence to support that claim. Yeah.
Okay. And then when you're looking at Europe, are there any kind of markets that you recommend people kind of look at?
I think maybe being slightly patriotic, the UK is a really nice sweet spot between admin, language, and kind of that supply impetus, but also the demand. So the UK is about 8 to 9% of Amazon globally, whereas the US is 65 to 70. Germany and the UK are similarly sized. Germany probably edges it in truth, but the UK's shares a language with the US and is maybe slightly less bureaucratic than the EU. But to be honest, there's not an awful lot in it. And therefore getting set up, and if it's going to be one market and one market only, I'd say for a US brand entering Europe, the UK makes sense. That said, if we are lifting the veil on it being one market, the EU makes so much more sense. I mean, there's a trade union. If you launch Germany, you can launch France, Italy, Spain, Netherlands, Belgium, Poland, Czech Republic, etc., 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 all through Amazon's fulfillment network. As long as you've got your VAT numbers set up correctly, you can launch all of those. You send stock into Germany. Amazon will distribute your stock across continental Europe, basically any EU member state, and offer pick, pack, deliver to the end consumer anywhere across that trading block within the next day. So that used to include the UK, but obviously Brexit somewhat got in the way of that, which makes life harder for UK sellers. But launching Germany means if you're willing to put that upfront legwork in on localizing all of your listings, etc., in all of those different languages and managing all of those marketplaces from a logistics perspective, Amazon makes life really easy.
Okay. And what do you kind of personally recommend in terms of, let's remove the UK from this, in terms of Europe? Which market should people kind of look at, and where is the demand and the juice kind of worth the squeeze, as it were?
Yeah, and again, it comes down to the product and the category of product quite significantly. I wouldn't launch sunglasses in Sweden, for example. But the overarching theme is Germany's the largest, taking UK out of it in about 9%. France is probably about a third to half of Germany. Italy might be about 80% of France, and Spain's probably half of Italy. Those were always the core four markets that Amazon launched way back, and don't quote me on this, I want to say 2019, 2020, something like that. But those marketplaces have been around for a while. Now, as of 2022, Amazon introduced Belgium, Netherlands, Czech Republic, Poland, slightly more peripheral markets, and it's always introducing new marketplaces. Ireland was bought out a few months ago. Now, again, going back to that resistance band analogy, if I was launching a resistance band, I would launch it in the Netherlands, Belgium, Czech Republic, Poland. It's a super in-demand product, and a lot of the big dogs do not bother with those smaller marketplaces. I'll fulfill it from Germany, they can wait 2 weeks, and that's fine. But there's probably an opportunity to go in, and there's probably sufficient market demand for resistance bands in Germany. Now, if we're talking about a super niche product, where it's a niche within the niche, that's targeted at a larger marketplace, and that's where Germany's going to be your best bet. It's got the most demand, it's the largest, and there's not going to be a swathe of competitors that you've got to push out of your way to kind of outcompete. That said, if you've got a generic product, I'd kind of trend towards those smaller marketplaces where you can really win and be number one.
Okay. If we can just hypothetically take a brand that's, US based, they're with you and they think, they agree, prioritize the UK first and then those kind of four main geos in Europe. Do you think they should do that all in one go, or is it kind of a staggered approach of, let's say, UK first, then Germany, see if it works, and then kind of go wider?
It depends. I think one of the biggest things that's probably overlooked by a lot of US brands launching into the UK and EU is the resource commitment on management time in going through that pursuit. So in America, you've got all of that demand for one marketplace. So from that operational perspective of making sure your listing's converting well against the most amount of impressions, blah, 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 and doing all of the things necessary to actually continue competing on site with your competitors, that's a whole brief for one marketplace. If you launch into the UK plus EU4, let's just call it at that, you are 5 timesing your management impetus to go and get, at best, probably between them, about 1-to-1 parity between the US and the UK and EU combined. And I always say 1-to-1 is probably where we often land, is because you've got probably about 30% versus 60% of the Amazon demand on US versus UK and EU, but where these brands might sit 5th, 6th, 7th, 12th in their category in the US, they sit first, second, third in the UK and EU because it's easier to compete. So it ends up at about parity once you've gone in and matured. But I wouldn't underestimate the amount of time that's required to manage 5 marketplaces, not one. And whilst it is easier from a logistics standpoint, you've got 5 sets of PPC to do, 5 sets of SEO to do, 5 sets of branding to do, 5 sets of kind of monitoring keyword ranks to do, blah 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 blah. And not least, you've got 5 different languages as well to operate within. So that's quite a brief, and you do really increase that. So I'd say if, and this is where I'm probably slightly biased, if you've got a management team and you work with someone like us, from a logistics standpoint, super easy to launch it all at once. And if you're doing the regulatory processes, if you're doing the VAT registrations, if you're going through that anyway, you might as well get it all done, because the cost isn't particularly different if you do it for one marketplace versus another, nor is the time spent massively different if you do it one marketplace versus the other. It's the management on the other side of that admin that you need to make sure you've got a good team in place for.
Okay. You mentioned there that, essentially what people underestimate is the amount of time and kind of admin of expanding internationally. What else do US brands, maybe have a misconception about or misunderstand about international expansion before they actually make the leap?
Yeah, I think there's a general lack of knowledge maybe across the board, not just from US sellers, but from those of UK and EU around product regulation. And that is a huge black box that, again, updates with time. And there's certain things you have to have done before you can legally sell your product in the UK and EU. Amazon gets in trouble if its sellers don't adhere to those regulations. So Amazon is super on the ball with making sure their sellers adhere to those regulations, and they very much have a shoot first, ask questions later policy when it comes to it, because the ramifications of Amazon getting in trouble for lack of compliance is billions. So they will hold they'll keep their sellers on a tightrope in that regard. Now, with that, you can end up thinking you've done everything required to launch in the UK and EU, send a load of stock into the UK and EU, and it can either get held at customs because you've not got a proper importer of record or you haven't done a customs declaration correctly. It can get into Amazon's fulfillment centers. You might go under the radar for the first couple of weeks, and then you get that red account health warning because you've not complied with something that you should have done. They'll ask you to send proof of something that you haven't done. That's very tough to do. But you ultimately get stuck with loads of stock in Amazon. You've then got to pay to remove, and if you're in the US, send it back to you. It's an absolute economic nightmare if you've not gone through the necessary diligence of making sure that that is done correctly across regulation, supply chain and logistics, and VAT. So I'd say a lot of people are aware of it, but there's probably 10 to 15 different boxes you've got to tick, product dependent, across those 3 factors to make sure that you've done everything right from a product regulation perspective, a tax perspective, and then also keeping Amazon happy perspective, which is a compliance box of its own.
And for just off the top of my head, right, for a business that's not working with someone like you guys, they're trying to figure this out on themselves. They're just Googling around and trying to, hit all of these kind of regulatory checkboxes. They're going to make a mistake, and this is going to waste a lot of time and money, essentially, right?
Exactly. And ChatGPT is fantastic for a lot of things, but I think in this age, you get a little bit too comfortable with it, and ultimately ChatGPT is not going to take liability for the tens of thousands of pounds of stock removal if it gets it wrong, and it does often get it wrong. So I think if you're going to pursue the UK and EU expansion, it's damage limitations to partner with someone that's done the process before, knows it inside out, not least for the repercussions of getting it wrong, but also the speed. I think if you don't know what you're doing, you can easily fill something out incorrectly, and the EU won't tell you that you've done it incorrectly and for 6 months, and then you're sat on your hands. Your competitors have then all launched into the EU ahead of you, and you've almost missed the boat. So it's again, I'm biased admittedly, but I think it's super important.
Yeah. You mentioned timeline. What is the timeline when working with you of coming to you and saying, I want to launch into the EU to, starting to sell?
Yeah, I think an average is 3 to 4 months, probably 2 to 4 months in best case scenario. And that wait time is largely speaking attaining VAT numbers. You can fill out the form on day one. It goes and sits on a governmental desk, and no one's got Mr. Starmer on speed dial to hurry that along. But that is just how long they take for someone to give us the rubber stamp there. The only exceptions where it can take longer is if you're selling a medical device, or supplements sometimes have a bit of a crossover with drugs, and where you draw that line is an interesting topic of debate. But a lot of these nootropic type things, they can be conceived as medicinal, etc., etc., etc. Then it's a much longer process, where you've got to do a load of testing, etc., etc. Basically, anything you're ingesting, they're going to take a lot more precaution on. But yeah, if it's a medical device or a drug, or something out of the ordinary, that can take longer from a product compliance perspective. But if you're selling desk chairs or t-shirts or something like that, that is a really quick process if you know what you're doing, and it's really just the VAT setup. But what we always say is, we'll apply for the VAT numbers on day one. We will go through, create the seller centrals in those 5 marketplaces, populate listings that we think are going to convert well in those marketplaces, and basically use that window of time to make sure we've done all of the market research, understand what units we're going to order to begin with, get everything, the kind of skeletons of the listing set up accordingly, so that when we do launch, we can hit the go button from day one and have everything ready to go. And that time is probably more or less what you'd need to get all of that done in all of those marketplaces in any case.
And then on in terms of making that decision, how does a brand know when they're ready for international expansion?
I often think it's sooner than the founder thinks. As I say, I think the barrier to entry in the UK and EU is significantly lower than that in America. So if you're competing well in America, or even, to be honest, averagely well in America, I think you can really make a splash in the UK and EU marketplaces. And I think it's something that companies have very recently started taking a lot more seriously, accelerated by Mr. Trump, and the tariff situation over in the US. So we've seen an absolute flood of US companies taking us up on this offer, on being their UK and EU partners, following that, because all of a sudden the US's certainty of free trade, the home of capitalism, is somewhat taken a hit on its reputation. And you've got a global network when you've got an Amazon business with which to sell your products, and one market out of about 18 gets hit with tariffs. So it's not necessarily, when it was 145% for a lot of these companies, it wasn't a choice. It was, we have to pivot from the US, otherwise we don't have a business. It's as black and white as that. Now, does anyone think that was ever going to last for longer than what it was going to take to get a negotiated trade deal over the line? Probably not. But I mean, we're still left at 55, and that's still quite significant. If the average cost of goods percentage in someone's P&L is 20%, 55%, there's still a mover in that margin. You're still just removing 10 percentage points on margin, and with these businesses operating between 15 and 25% on a good day, that shifts things.
How should someone, because obviously the constraint for a lot of these kind of decisions is capital, right? How should someone think about making a choice between launching a new product and expanding internationally?
Well, I think you've got 2 choices. You can launch a new product into a market that's new for that product, or you can launch a new market with an existing product you already know works, you've already built up a review base for. I would always prefer to take one product global than build a collection out, unless there's a huge trend for the brands that you've got and you need to get on the next thing before you miss the boat. I think going global is easier, particularly US to UK and EU, sometimes the other way around as well, but particularly US to UK and EU is so much easier. You take an existing review base, an existing supplier, an existing product quality, an existing brand and packaging, and you bring it into the UK and EU. I should note that the brand and packaging has nuances with compliance, but you're bringing that into the UK and EU. It's tried and tested, and it works, and you've just got the ability to open that up. It's not like you have to set up a warehouse in the UK and EU. You've got to hire staff. Amazon, it's where Amazon is king. It takes the logistics out of that decision-making process, and I think you can have those in one marketplace or global marketplaces, and for as long as you're willing to bide your time during that 3-month period of admin and bureaucracy. It's a bit of a no-brainer. It's almost low-hanging fruit on the other side of that administrative setup.
Okay, so I think especially we're talking about US brands here, it's a lot less risk to expand internationally than it is to create a new SKU or product.
Yes, and I will caveat and say that's probably not the case the other way around. You take a UK or EU brand, it's the opposite dynamic. Yeah, it's not to say that it's impossible to do. We've done it several times over with brands we worked with, but it's much harder. You've got to have much deeper pockets. And again, you've got to make sure you've got that niche within a niche, because in the US, the trade protection that almost comes with that regulation in the UK and EU somewhat keeps Chinese suppliers out of the market from them just going direct to consumer. Not completely, but it takes the bulk of them out of the market because they need to get VAT registered. They need to comply with product regulation to a much larger extent than the US. So the obvious thing is to do the US on that side of the aisle. So going into a market where you do have that slight trade protection into that mass frenzy of the US is a lot harder to compete. So in that instance, maybe launching a new product is a safer bet, but might not be the most lucrative.
Makes sense. I want to shift gears now and talk about the kind of third piece of the offering, so helping businesses exit. At what stage, you're kind of working with a brand for a couple of years, at what stage are you kind of saying, we might be ready to take this to market, and what are the kind of characteristics that you're looking for there?
Yeah, so largely speaking, the businesses we work with, we take minority equity positions predicated against KPIs. In essence, we partner with a business that's worth £1 million. If in 2 years' time we can make this worth £2 million, we want X percentage of the transaction value at the end. That's the type of value prop that we offer. But by virtue of us taking minority positions, KPI'd in, we don't necessarily have control. So it's largely what the founder wants. Now, obviously, they take our opinion on board and hopefully value that opinion. But it's largely what the founder is motivated by. And we have some founders that are motivated by time, some founders that are motivated by valuation. And it's a spectrum that everyone sits on. And some people say, I need my business gone by the end of the year. We're a husband and wife team and I'm planning on getting a divorce. I need that gone. Some people say, look, I know my business is worth X million pounds. We will work until we reach that valuation target of X million pounds. Now, 99% of people sit somewhere in between the two. But it's about taking that on board and on day one, reverse engineering that roadmap to the point of exit that hits on those motivations. So when we get there, there's probably a lower floor of when we can exit a business. There's a certain level of scale that's required from businesses to find a buyer, albeit in the instances of smaller companies, we'll try and find private investors or micro funds that will come in and purchase them. But really, it needs to be 7 figures up on valuation for an exit to be tenable. But going back to the motivations and then what makes sense sort of economically, you've got, again, those operational pieces, which are the low-hanging fruit wins, and then you've got the structural pieces. My opinion is fully that there is virtually unlimited growth for an Amazon business available, because you can run those operational optimizations and make sure that you are winning in the current products that you've got in the current marketplaces that you offer. Then you take those current products, branch them out to a global network of marketplaces. Once you're winning in all of those products in all of those marketplaces, you can then branch out and launch the next product. I think stat is, and again, don't quote me on this, I think Amazon's sales are higher than the GDP of Latvia. You are never going to do enough in sales that Amazon ceiling becomes a problem. So there's always the next product that you can launch and branch out into. So it really does become a matter of, okay, we've got those operational optimizations right and correct. Do we want to exit, or do we want to go and do the next thing from an Amazon perspective?
Would you ever raise capital, so kind of work with a brand, get that minority stake, and then go out and raise capital to get to that goal faster and then turn around and kind of sell the business? Or is it just kind of work with the capital and the business and sell it when it reaches its natural runway?
Yeah, we've raised capital on behalf of a lot of our portfolio companies. There's a good few credit providers in the space that we know quite well. What I would say is that was a much easier decision to make when rates were lower. We're seeing them go down again now, but the last couple of years, I think general fear around the space in tandem with kind of what happened to the buy side meant that rates for Amazon businesses and e-commerce sellers as a whole became really expensive. So you're talking anywhere between 12 and 20% APR, and for the best possible providers of capital, you've really got to make sure there's going to be a return on whatever you're going to do with that capital if you're going to be paying that level of interest. So if it's going to be to go and buy, if you're a seasonal business and you're planning on growing 50% year on year, and you've got no cash flow from the summer because you sell dehumidifiers in the winter, going and taking out that debt in the summer to purchase the inventory for sales that you've pretty much nailed on are going to happen over the course of that winter, it's a safe bet. I wouldn't necessarily look to take out 20% interest rate capital against a product launch, which has a lot more uncertainty attached to it. When that was 8 to 10%, different story.
I don't want to get into a like financing debate here, but when you're injecting capital into a business or raising capital before the exit, are you largely doing that on a debt basis rather than equity?
Yes, but only because there's not necessarily institutional equity offerings, and perhaps a gap in the market. But at the moment, the credit providers are debt facilitated. There's get private investors that look to take equity positions. We've done a few of those deals, but there's no kind of systemized process of going through the motions there.
Okay, getting back to off of that financing debate, what are you guys doing? So maybe let's take that hypothetical £1 million business that you want to get to 2 million and then kind of exit. What are you guys doing on that journey to prepare them for exit? So not kind of taking the Amazon growth side here on the prep for exit or the roadmap to exit. What are you guys doing throughout that doubling process?
Yeah, well, fundamentally, I think it's important to note how these businesses are valued at those types of valuation ranges. When again, not stepping into any complex finance debates, it's very much there's a profit and there's a multiplier that gets attributed to your profit within the business. We're not looking at any complicated tech valuations. There's no DCFs. There's nothing like that. It's very much, does this business make money? How much, and what are we willing to give on that as a multiplier, as a valuation to that company, plus then the net financial position on the balance sheet or the equity on the balance sheet. So there's two things you can do in scaling a business. You can scale a business's fundamental profits. If a business is valued at profits times a multiplier, you can either scale its profits or you can increase the multiplier that the business is going to gain for the profits that it's garnering on a yearly basis. Now, we aim to do both. So again, looking operationally, there's all of those list of things that you can do: impressions, click-through rate, conversion rate, every product globally, every market, bring new products to market where we see fit. And that should, within that kind of operational process of management in these companies, see that fundamental nominal profit increase. The next question is then, how do you make sure you maximize the multiplier that you're achieving on exit? And that is it's probably four factors, both quantitatively and qualitatively. So quantitatively, you want the highest possible revenue, the highest possible profit, both nominally, the highest possible margin, and the highest possible year-on-year growth. So quantitatively, those four metrics optimized for as high as possible. Reason being is scale is king. If you imagine these private equity firms that are going to be acquiring these businesses want to acquire them and then put someone in charge to manage that business. If you've got a business doing, say, £500,000 in profit, you can afford to put a CEO in place on 80 grand for this business and still have capital left over to repay your interest or credit providers, and then also make some profit as the private equity group. If you've got a business that's doing £100,000 of profit and you're acquiring that, you still need to put that same CEO on there. There's still the same level of operating expenses required to manage that business. You've got 20k left over, which wouldn't cover your interest or your credit repayments. So there's a level of scale that you need to hit for that to make sense. And then margin is seen as just a pure antidote to risk. Again, you look at that geopolitical event of the tariffs over the last couple of months, you see businesses that if you've got sub 15% margin, you basically just had your business wiped. You can have a business doing millions and millions and millions of pounds in nominal profit. If you're manufacturing in China and you're selling in the US and you're at 12% margin, you are now at 1% margin. It's overnight, and 145%. That was when it was at 145%. So there's these nuances, and again, depends on the unit economics. But margin, the higher, the less exposed to geopolitical risks they are. Likewise, container prices can go up, oil prices can go up, Amazon fees can go up, all of these different things. Even inflation on cost of goods, whatever. The higher the margin, the more productive the business. And then lastly, year-on-year growth. Now, a lot of aggregators will ask themselves the question when they're acquiring these businesses in the seven-figure range, right? After we acquire this business, how do we take this to 20 million pounds plus? Because that's when they can then exit to larger PE groups or likewise consolidate and aggregate and live off the income of them. But their fundamental questions is often, right, 20 million seems to be, I don't know if it's arbitrary or otherwise, but it seems to be the target that a lot of these private equity groups look to. This is a business we're buying for £3 million. How are we going to take this to 20? If your year-on-year growth is plateauing at the point of a 3 million valuation and the buyers are interested in businesses that are going to go to 20, that's challenging. So it doesn't have to be 300% growth year on year, but it has to be growing. They're not going to catch a falling knife. There's a lot of companies in the space that peaked really well during COVID, got in at the right time in 2017, peaked during COVID, and have been on a slight downward trend since. No one's going to put a nice multiplier on that. So we come into a lot of those types of businesses, try and kind of run that operational model to turn these businesses around and then recover that. And then you can quite easily justify that as a blip in proceedings rather than the wider trend.
In terms of multiples, we are filming this, almost halfway through 2025. What would you say is the kind of rough range that 7, maybe low 8-figure brands should be looking at, and how can they get towards the top end of that range?
Yeah. So like I say, those are the quantitative metrics with which to maximize the multiplier. On the qualitative side, people really look for brand equity, anything IP, so patents, social media followings. What have you got that no one else could launch tomorrow and replicate is super important. But then also aggregators and the private equity firms within our space particularly have really kind of matured, and we're seeing flow pick back up over the course of the last sort of year. It did take a downturn following that buying frenzy of 2021, 2022. But we're seeing that come back now, and the conversations we're having are a lot more sensible, I'd suggest, in the multipliers that are being offered, but also in the way that these businesses are being acquired. Back in 21, 22, as a buying frenzy, anything with a P&L and a pulse would get a 4x multiplier offered to it. And a big part of the reason I think a lot of the aggregators failed is because I think there's an argument to suggest that they didn't fully understand the e-commerce space coming into it, and very finance brain on it. There's a P&L, we can aggregate these, increase the multiplier, diversify risk, sell for a wider portfolio valuation. Makes sense on paper. In practice, you've got to actually run these companies. I think more emphasis was put on these being tech companies rather than companies that need management than it played out as. And number two, the lack of synergy, I think really mattered. I think the private equity groups expected there to be inherent synergy by virtue of the fact that they were acquiring businesses within the same kind of vertical latitude, being Amazon businesses. Now, that's well and good, but if you're buying desk chairs, vitamin C, and face masks, you're not going to get any economies of scale on your supply chain. It's going to be different suppliers. You're going to have 100 different brands, 100 different suppliers, 100 different supply chains, 100 different management teams running these businesses. I think fundamentally that's where they weren't then able to blend out operating expenses underneath them because the synergies that were perhaps anticipated didn't necessarily exist. So going back to that point, the aggregators now following that sort of not quite boom bust, but certainly buying frenzy down period. Flow's now picking up, and the conversation we had is aggregators have all sort of found their lane. So some people acquire Amazon businesses, and their job is to take them into brick and mortar retail. Some people buy Amazon businesses, and they've set out to go and open D2C and Shopify. Some people buy them within categories. So you have a baby aggregator, you have a supplements aggregator, you have so all of these lessons have kind of been learned. And with any macro event like COVID, there's going to be a load of capital raised, particularly with free interest, and spent quite quickly, as it was. Lessons learned over the last 3 or 4 years, and the conversation you're having now are a lot more concerted. Buyers have found their lane, and are sticking to that, and they're asking a lot more longer term questions rather than how has this business operated in the last 12 months, and let's value it solely on that before someone comes next to us and buys it from underneath us. So that's everything that influences the multiple. I think anywhere between 2 and 4x is what we're currently seeing on yearly earnings, and that's adjusted earnings after add backs. But that said, it's a slightly open-ended question. I could get you an infinite valuation for your business. I'd buy your business. I'd promise to give you 50% of profits in perpetuity. I've got you a infinity X on your company. It's all about the deal structure, and that's a much larger part of the conversation now than it was a few years ago. Again, commensurate to the interest rate conversation ongoing. So I think what we tend to see is anywhere between 60 to 80% upfront on deal structures, and with that a 2 to 4x multiplier on businesses. And to be honest, if you're talking within the mid 7-figure to 8-figure range, that's probably no lower than 2.75. Really, it would have to be really on a downtrend. But again, it all depends on those qualitative examples. And like I say, the deal structure makes a huge difference. People say, look, you can stay on as the CEO, you can have a 60% of profits for the next 5 years, but we need you to help us integrate. So you'll get 3x over 5 years, plus we'll give you 2x up front. That's quite normal, and then it's a 5x, but it's not really because the CEO is bound to the position for the next 5 years. So it's all nuanced, and that's why I probably didn't give a straight answer in the first instance. But 2 to 4x is a good ballpark for 7-figure brands. Going into the 8 figures, it maybe increases somewhat, but again depends on growth trajectories. And you get some brands that are really exploding, and it quite quickly moves away from profit multipliers and into the revenue multipliers. And again, scale is king in that regard.
Okay. Can we just round things up by just talking or touching on what you said there about structuring? So I know I speak to quite a few founders, and they're not sure about this process, and they don't want to be tied in and kind of all this stuff post exit. Mm-hmm. What have you seen is the kind of common divergence between kind of founder goals and reality when it comes to an exit? And are there kind of anything that leads, any common things that lead to deals falling over essentially that could be avoided?
Good question. There's one that I was dealing with today, Dutch company, and got a LOI through, letter of intent through, to purchase the company on a asset deal. So they would acquire the trademark, the inventory, and basically all of the assets that the business owns. Again, getting really technical into deal structuring, but they'd acquire the assets into their company. And that's seen as a simpler way of doing things than acquiring a 25-year-old Dutch entity, of which the due diligence has to be far more thorough, far more rigorous. You've got to go through 25 years worth of history and work out if there's any skeletons in the closet. You're going to acquire an entity that's going to get slapped with a tax fine for tax that went unpaid in 2012. We've worked with them. I would highly doubt that is the case, but the buyer doesn't know that. So you've got to spend a lot more on due diligence, lengthier process, and blah, 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 blah. So that's just a top of mind example that might not be relevant to 90% of deals, but just an example of all of these kind of things you wouldn't even think about that can mess up deals. Now, fortunately, we got the news a few hours ago that they're going to move that to a share deal offering, and all is well and good there. Again, there's pros and cons to both. but that is what the founder wanted because there's tax advantages to selling a company versus selling the assets within a company. So super niche. But yeah, deal structuring is another big one. The extent to which the CEO is going to be required or the founder is going to be required to stay on in the company is another one. Most founders I speak to are happy to. They fundamentally want to see their company succeed in its successors' hands. A lot of the time, it's not financial motivators. It's you've got to remember this is companies people have been working on for 10, 15, 20 years. It comes to the end of the process, and a lot of it comes, okay, well, who is this guy? Like, are they going to take good care of my baby? And the fact that they can stay on and smooth over that transition, secures their kind of earn out piece of the deal. So if you are going to get 80% upfront, that 20% is a lot more secure if they stay on in an advisory position full time. That hasn't been too much of an issue that I've found. But there's loads of things that can come up in due diligence that cause issues. And be here all night if I told you about the amount of deals that have fallen through because of really bizarre, wacky things.
I can imagine. But anyway, I think we'll round it off there. We are coming up on time. Harry, thank you so much for taking the time to come on the podcast. It's been a pleasure speaking with you.
Thank you very much, Jordan, and appreciate you having me on.
All good. 2 final questions. Firstly, if people are interested in what they've heard, what type of businesses should reach out and where can they find you?
Yeah, so I think speaking throughout this podcast, there's probably 3 categories of companies we work with. Number one, US businesses looking to come and get a slice of the pie in the UK and EU. I would argue that's really low hanging fruit. And we've taken over 50 US businesses, international, going through the full regulatory process, and then becoming the UK and European partner to actually launch and scale those brands in all of those marketplaces as well. Number 2 is if you've got any interest whatsoever in selling your brand and don't really know where to start, don't know where to kind of best reverse engineer that conversation, you need to start thinking about it in an ideal world, probably a minimum of 18 months before you hit that sell button to best reverse engineer your multiplier that you're going to get on exit. And then lastly, anyone that's got brands that aren't on Amazon. Amazon's 53% of e-commerce demand in America. And whether you think you are or not, if you are spending money on paid ads or influencer campaigns for your business away from the Amazon platform, that search traffic will find its way onto the Amazon platform. And we can help you scoop that up and make sure not only do you scoop up the branded search, but we can use that to leverage it and position you as highly ranked underneath wider search demand that represents 53% of e-commerce in FMCG to your brand as well. So if any of those apply, by all means, get in touch and we can have a conversation about what we can do together.
And what's the best place to find you?
LinkedIn is probably the best bet. So Harry Nicholls on LinkedIn.
For sure. Well, Harry, thank you so much for taking the time. I've learned a lot and I'm sure everyone that's listening has too. Thank you.
Thank you very much, Jordan.
Scaling an e-com brand is hard. That's why we're on a mission to share as much info as we can to help make it easy. From weekly interviews with the biggest names in the space to case studies, brand breakdowns and tips and tricks, and much, much more. Subscribe so you don't miss out.